All right. Well, good afternoon, everybody. Welcome to today's webinar. It is exactly 1 o'clock, and we're going to go ahead and get started. Thank you so much for arriving promptly, and we'll certainly be respectful of your time today and get you hopefully some good quality information and be wrapped up by 1:30 today. My name is Jason DeBono, Vice President, NewView Trust Company. I've been here with NewView now for 14 years, and I've served in a lot of different capacities, and one of my favorite roles is being able to host and provide educational content. And I think on the angel investing side specifically, I think it's not only is it content that more people need, but we're really starting to see a major uptick in a lot of the angel investors and a lot of the funds that are out in the marketplace trying to raise capital realize that IRAs represent a very opportunistic approach to getting deals funded and getting businesses off the ground. So we're going to talk through that a little bit here today. There is a chat functionality, so at any point, if you do have questions, feel free to type those in, and those will pop up on my screen. Thank you. Someone just said the audio. I'm going to move the mic up a little bit. Hopefully that's a little bit better, so you guys can hear me okay. But if you are having any issues, please let me know via the chat. But I'd also encourage you, as we go through this, please type in questions as you have them. We have too many people on today to have the audio open for everybody. It just makes it a little bit too difficult. But I can drone on for 30 minutes, but find that this is a lot more productive if we have the ability to have some discussion as we go. I don't have a lot of slides as we go through this, but I want to make sure that we cover the meat and potatoes of really what it is that that angel investing looks like inside these self-directed accounts. And so without further ado, we'll go ahead and get started. So the first thing I want to talk a little bit about is what are the benefits of raising capital from retirement accounts. So the real kind of origin of all of this is, businesses need money to get off the ground. It's very common, and we're talking about businesses that are raising money, and we'll say friends and family. I think that's a good starting point. But this is really any sort of money, any sort of seed rounds or any sort of capital that's really before the venture world. A lot of that is individual investors. Again, a lot of that is friends and family. But ultimately, at the end of the day, the capital market available of just IRA assets is $2.36 trillion. Now, that number is significantly larger when you calculate in 401k plans. The reason that I left that off, and the reason I only talk about IRA assets, is there's no question of the $2.36 trillion that every dollar of that is eligible to be moved into an alternative asset. 401k plans represent a much bigger pot of money. However, there's a lot of restrictions if the individual is an employee or active participant in that 401k plan that may prevent them from making an angel investment. So it doesn't mean 401ks are off the table, but we really want to talk specifically to IRAs or 401k plans where the individual is no longer employed with the company would all be eligible to be rolled over. Average IRA balance, and this is per individual, so this could be a series of 2 or 3 IRAs that an individual owns, but that average is at $123,000. So you obviously have, as you can see in the bottom right-hand slide, graphic, which I know is a little bit harder to read. Certainly the numbers skew by age. So if you were to go and look at the average balance of someone 50 to 54, it's $91,000, and you can start to see it climbing 122, 165, 212, and 219 as these individuals that are prospective investors into your offerings, as they age, they naturally accumulate more money. The number is significantly higher as a percentage of overall assets. If you take a look at the slide on the left side, that the kind of yellowish group there represents retirement assets. And if you look down at net worth, really of 100,000 and $1 million, but at least at $1 million and above, which represents accredited investors, look how large the amount is there of benefit or retirement benefit accounts. If you notice, I think what this chart tells us is that as people build more wealth, they spend a significantly lower proportion on vehicles, significantly lower proportion on primary residence, but they increase the proportion of retirement assets as well as business assets. So I share this because if you're kind of thinking about where the sweet spot is, our average client is in their 50s, and they have a little over $150,000 with us. So that gives you an idea of what's out there in the marketplace. And so you have a series of of individuals that meet a great criteria that also have a lot of business interests, and you can couple those two things. Both their desire for business interests, which is that dark blue on the right-hand side of that chart, which grows significantly with net worth, which tells you these individuals have an appetite to invest into business, and you can couple that inside the tax-advantaged accounts of their retirement assets. It also is represents a large amount of liquid cash. So for a lot of investors, simply their liquid cash is in their retirement account. So it may be currently invested. They may own a series of stocks and bonds and mutual funds in that account, but all of that is liquid. They can liquidate that today and move it into an angel investment, whereas their personal cash may not be as liquid. It may be tied up, as you can see from this chart, in other business interests or other things that may not be as liquid. The other thing that's really important around why why retirement accounts can be attractive for you is retirement accounts represent patient money. And so when we talk about that, if you're on the capital raising side, whether it be an angel fund or whether it be a portfolio company raising money directly, it really doesn't matter. The general premise of your investment is long-term. Very few of these investments are in and out. And so if someone is looking to put in $50, $100, $200,000 into an offering, that's going to last for 5 or 7 years while the company gets off the ground, they may not want to tie up their cash for that long because they're concerned that maybe junior's got a college bill in a couple of years that they want to make sure that they have adequate capital to pay. But if they're using a retirement account, they know that money's already earmarked for a long period of time. So it matches both the investment philosophy of angel investing alongside the investment philosophy of a retirement account. So as an individual, why would someone want to make an angel investment inside a retirement account? Well, the first thing is tax-advantaged or tax-free growth. So the slide on the right now is very simplistic. It shows a dollar doubling, and it shows it doubling every year with no tax, with a 17% tax, and with a 27% tax. And the whole purpose of this illustration is not to assume that you can double your money every year, right? That would certainly be awesome. If that were the case, we'd all put $1 into our retirement account and 20 years later be over $1 million. But if they make the investment into a Roth account, which would be that first column there, growth with no tax, they end up with $1 million when they're all done. If they make the same investment and they get taxed at 17%, they only have $177,000. And obviously the 27% is significantly less at $57,000. So the part that's very important for your potential investors to understand is, even if all things are equal, even if the investor has money in all the different, in different pots where they don't have to decide personal money or IRA money, it may simply represent the best tax advantaged opportunity. And as we know, with a lot of tax and with a lot of angel investing, there can be significant upside. And so the best place for that significant upside is in a tax-free account. We touched already on long-term investment account. That's important for a lot of your investors or potential investors. Asset diversity. This is something that really isn't talked a lot about. We talk about diversification, and you hear that term, and it's kind of a term that's probably used, incorrectly in so many cases, right? If you look at the market, very rarely do you see 4 stocks go up and 4 stocks go down. All the boats tend to rise in a rising tide, and they all tend to sink in a lowering tide. And so diversity for investments that are outside the public markets that aren't correlated to what's going on in who knows where news is going to come from. I think we've seen the markets rattled over the last few days with one tweet on a potential tariff to Mexico. These types of assets don't correlate with the stock market. They may correlate with the overarching economy, but they're not subject to that same level of correlation. And so it's an opportunity for true diversity for a lot of your clients in their retirement accounts. And then the thing that we find that tends to be a very important opportunity for investors with retirement accounts and with angel investments or any alternative or private investment is investment understanding. If you were to take an individual that had $100,000 and they could go put that into Microsoft, other than maybe being a user of some of Microsoft's products, at the end of the day, they really don't understand Microsoft, the underpinnings. They don't have direct insight into, Bill Gates's thought process and all the other parties that are making decisions there. Yet, when I invest into an angel investment, a lot of times I can meet the CEO, the founder. I can see that passion. I can understand exactly how they plan to monetize it. I can understand some of the decision-making process that's going into it. I can meet the team. So I have this innate understanding of what this group is about, whereas in a traditional, stock, bond, or mutual fund, I could never get that level of understanding. So there's a knowledge base that you can be talking to your potential investors about, and providing a good understanding for them as to why they may be interested in making, some type of angel investment within a retirement account. At the end of the day, the part that we find most clients are attracted to is the tax advantage growth. When you can start making investments into things that have upside of 3 and 4 and 5x, and know that those investments can be returned in a tax-free manner in the case of a Roth, or a tax advantage manner in the case of a pre-tax IRA like a traditional or a SEP, that's a significant advantage over using personal money for the same investment. And then you couple in these long-term investment vehicles, diversity, investment understanding, and you'll find that a lot of investors are itching to do something more, better, unique, or different with their retirement money. They just don't have opportunities, nor do they know that opportunity exists. So let's talk a little bit about some of the considerations, because obviously the process, while it's easy, there's some landmines and some things that you may be familiar with, you may not be familiar with, but I want to put them out in the open, and I want to discuss them in better detail. So the first thing that we run across is prohibited transactions, disqualified parties. The IRS allows individuals to use their retirement accounts to make a myriad of investments. In fact, the only two things that are disqualified in an IRA as an investment are life insurance and collectibles. So there are very few restrictions on what an IRA is eligible to purchase. However, there are quite a few restrictions around the parties that the IRA is able to do business with, and those are referred to as disqualified parties. And the idea behind that is really to avoid two things. They're avoiding self-dealing, right? People utilizing their own best interests or personal interests, right, at the expense of their IRA's investments. And number two, they don't want to create a tax shelter. And so with any tax advantage vehicle, they have to fence off some certain people to make sure that there is no funny business going on between those parties. The IRS publishes a list, or has created and publishes a list, of everyone that they consider disqualified as it relates to an IRA investment. So what does that mean? It means an IRA cannot invest into anything, regardless of the asset class, if the following parties are highly involved with the deal in any capacity, and without question, if there's a direct correlation between the IRA and the individual. And those individuals are you as the IRA owner, your spouse, your parents and grandparents, children and grandchildren, and the spouses and businesses of any of those parties. So if I, right, Jason DeBono, were to go out and start a business, and I was going out to seek angel investing, as a general rule, I cannot use my own IRA to invest into the company that I own and operate. And the reason for that is it's not arm's length in the eyes of the IRS. The IRS would be concerned in a few different capacities. One, they'd be concerned that it's not the best investment for my IRA, that I'm only doing it because it benefits me personally. And the IRS doesn't want you utilizing your IRA to simply try to get yourself ahead personally. It's there to give you tax advantage growth to retirement. The second thing is the IRS has no way to police how I manage the movement of money between those two accounts. And so I could certainly use it as a tax shelter. If the business takes off, obviously I can start dumping money back into that tax advantaged or tax-free account. And so for that reason, the IRS says you can't do business with yourself, and by extension, your spouse, your parents, your grandparents, your children and grandchildren, spouses and businesses of those parties. So when we talk about friends and family capital raises, this is not a way for your immediate, direct lineal descendants and lineal ascendants and descendants to participate in your offering. Those parties have to use taxable money. So they're not precluded from investing, they're just precluded from using retirement and money to invest. But your cousins, your aunts, your uncles, your nieces, your nephews, friends, all of those parties can make this investment without any sort of disqualified party risk. So we run into this, we want to put it out in the open. This in no way could, should, or would keep you from utilizing IRAs as a tool to invest for potential investors into your angel investment opportunity. But you need to make sure that when you do talk to someone that's on that disqualified party list, that you inform them that they've got to go the taxable account route simply because of their relationship with the investment itself or the parties involved in the investment. And again, if you do have questions, please type those into the chat. I know we're covering quite a bit of info here, and I do this every day, and I recognize that it may be a lot to absorb. So please, if you need any areas of clarity, simply type that into the chat box and I'll get that addressed. Annual asset valuations. This is another area that we hear from a lot of the angel funds or from the portfolio companies, and that is that they have no real means of providing a valuation. And this is a little bit of a sticking point because the IRS requires that an IRA-owned asset of any kind, stock, bond, mutual fund, alternative investment, have an annual valuation. So, there's no right answer in how to manage this. Obviously, that's got to be dealt with at the individual portfolio company level. But what we recommend and want to make sure everyone understands is they're not looking for a full-blown third-party valuation. They're not expecting you to hire evaluators to come in and dissect the books. What they're looking for is a good faith estimate on where that asset stands at that snapshot in time. So if I put in $50,000 or $100,000, it really doesn't matter, into an angel investment, as of 12/31, at the end of that year, the client as well as the IRS need to be informed, again, in a good faith estimate of where that asset stands. So there's a few different approaches that people take to it. Some groups look at material change. So from the time they've raised the capital to the time of valuation, has there been material change? If the answer is no, then they value it at the same price. So there's been no material change. We've raised a little bit more money. We haven't done anything that's been unique or different. We're still in the similar place that we were, and so they'll use the same value. So they're saying, to the clients, hey, we're not telling you you can sell it for this price today, but we're telling you that in good faith, we believe it to be in the same valuation as when you made your investment. If things have changed positively or negatively, then that price should be updated, again, in good faith, up or down. And we've seen a lot of angel groups that have given a clear disclosure to say, this is a good faith estimate, can't be relied on for anything other than, an annual IRS valuation, and here's the basis for the valuation. And it could be as simple as what I just mentioned. We've seen other approaches against a multiplier against EBITDA. Obviously not, some of these companies may not even be to that point, but we see them value it with a good faith estimate around EBITDA or some other, accounting related approach to valuating it. And again, they're providing that out to their IRA investors simply with the appropriate disclosures to let them know that we're not saying that you could go turn and sell it for this today. We're just saying that from the time you bought it, based on the changes that have occurred in the company, we believe that the value of what you hold has increased or decreased by X, right, for these reasons. So most groups that have taken this on, and there's thousands upon thousands of angel groups using IRAs, have found this to actually, while it appears to be a big hurdle and can be a mountain if you let it become a mountain, they've taken a very simplistic approach. The CEO is signing off on it. They're not using third-party valuators, and they're offering their clients, if they really want to go get a full-blown valuation, to do so. No client in an angel investment is ever going to set that expectation, right? They understand when they make an angel investment that it comes with the territory, is you don't quite know what it is until someone's really comes in and there's some sort of triggering event that's going to be able to put a real meaningful price tag on it. Looks like I've got a question that's popped in, so I'm going to pause for a second and get that. So it says, how does a prohibited transaction rule apply to SPVs? Can I invest in an SPV which is invested in a business where my daughter works? So the question really is around, if I invest into an SPV, does that SPV now have restrictions on where it can make investments? So I'm going to dissect this, if everyone's okay, into a couple of different areas. And I appreciate the question, and I'm going to maybe generalize the question a little bit so that others with similar situations may be able to apply what I'm about to say in that manner. So the first thing is, my IRA's investment is into the SPV directly. So the first thing is the SPV prohibited? So is it operated by, managed, or in any way, shape, or form dealing with disqualified parties at the SPV level? So if the answer to that is no, and I'm insinuating a little bit here from the question, then the first part is there'd be no question at all that would be a permissible investment. From there, the question becomes, what percentage or how diluted am I inside that SPV? If I'm an insignificant part, meaning my IRA owns an insignificant piece, and my role at the SPV level is de minimis, if I'm making all the decisions, then it's probably not a de minimis role. But if it's a collective board that makes all the decisions, then really the SPV is not disqualified to any of the investments I make, because I, as an individual, don't have any control as the IRA owner of what that SPV does. So there would be no follow-on or pass-through disqualification. That SPV could go invest into my daughter's business without any risk of a prohibited transaction, because I personally had no involvement, or I served a very de minimis role in the decision making. It was made by unrelated parties, which would keep it an arm's length transaction. Then the latter piece is whether or not the investment in and of itself is disqualified. So let's take the SPV out of the way, and let's ask, could your IRA invest directly into a business where your daughter works? So obviously, you as the decision maker for your IRA, that's a prohibited, a disqualified entity as it relates to your daughter. But the question is simply working at the company enough to make the entity disqualified? So if your daughter owns the company, then without a doubt, your IRA could not participate in that investment if you were the one directing it. So either directing it through the SPV or directing it directly from the IRA. If you're passively investing in the SPV and the SPV invests into that business, you would be just fine. In the case of a direct investment, the fact that your daughter works for a company doesn't make it disqualified, right? It would depend on the role that she serves. So if she's an officer or director level, then you'd want to peel back the onion a little bit and look and see. It'd be in the gray area. If she owns 50% or more, it would be disqualified. But if she served in a non-officer role and only owned 1% of the company or had no ownership interest at all, there'd be no question that would be permissible. It would not be considered disqualified because her role in the company doesn't make it disqualified. So hopefully that made good logical sense. Again, I'm trying to answer that in the grandest approach to being able to use that in other scenarios. I appreciate that question, and I think the key takeaways are you've got to really step back, and I think it's really important. I always use the example, if you were to take the party that's in question out of the deal and insert a stranger, would the terms of the deal be done the same way? If the answer is yes, then a lot of times, it's probably okay. So for example, if you're going to be making an investment and you're concerned about whether or not someone is disqualified, take a look at what you're doing and look at that deal and say, is the party providing any value? Is the fact that your daughter works for the company, which is not a disqualifying activity, but is the fact that she works there providing you some unfair advantage or value? So for example, if you're buying a $50,000 unit for only 40 grand because your daughter works there, then it would be disqualified because you're getting a direct benefit personally or in your IRA based on the fact that your daughter works there. And you can't do that in a tax advantaged account. But if you're getting no additional benefit, you're simply a passive investor, and her role is marginal enough to where it's not considered disqualified, then you're going to be just fine. So hopefully that puts some clarity on that. Please, if I created more questions, feel free to type those in. I know that this can be a little bit of a confusing part of the discussion, and certainly is hard in a webinar setting, but please continue to ask and I'll drill down as far as I need to. So we talked about annual asset valuations. Hopefully there's no questions there, but if you do have them, let us know. That certainly shouldn't be enough to keep someone from doing these deals. It just comes with the territory, and that portfolio company should find a good happy median where they feel like they're providing enough value to satisfy the IRS's simplistic requirement of an annual valuation without putting themselves into any sort of risk from providing a material value. Unrelated business income tax. This is a tax that may apply at the IRA level. This tax only applies to pass-through entities. So if any of the portfolio companies are corporations, a C corporation specifically, this tax does not apply because the tax is paid at the corporate level. If this is an S corporation, S corporations are prohibited from directly taking on IRA investors. And that has nothing to do with the rules of IRAs. It has to do with the rules of S corps prohibit IRAs as investors under the tax model. If the business is set up as some sort of pass-through, predominantly would see that as an LLC, maybe a limited partnership in some rare cases. Then if the business is generating operational taxable income, so meaning business income, not passive income, but general business income tax from operations, then the IRA may be subject to a tax on that. The nice thing with unrelated business income tax in most of the transactions we see is that the tax that's in an angel investment, most of these angel investments have losses early on. They tend to not be positively cash flowing companies, at least up front. So they can generally carry those losses forward until it becomes a cash flowing investment. And generally, once it's cash flowing, it's liquidated, right? It's sold, or there's some liquidity event to cash out your investors. And what's nice is the liquidity events generally represent simply long-term gains, which are not taxable in an IRA. They would be taxable outside. So UBIT, not to suggest it cannot apply, but if the business is not generating operational business income or it's carrying forward losses in the few years that it does generate that operational business income, a lot of times it's offset there. So just be aware it does exist. We can talk in a more specific manner about a particular company and where you're headed. We're not tax advisors, but we can at least give you an idea that, yeah, in most cases, they're not going to have an issue with it, or yes, they may, in years 3 or 4 if the business is turning a good profit. But liquidation events, proceeds from sale are not considered business income. They're passive, they're from the proceeds of the passive part of the stock ownership. And obviously that is not subject to the UBIT tax. So something that you should be aware of, but again, like a lot of things we're talking about, not enough to scare you off in any way. And then the last item of discussion is capital calls. So this is something that we see in various investments that do have them. If you have an offering that does have a capital call, just be aware that the capital call is limited to the IRA balance. So if I'm going to make an investment where I may have to invest $200,000, then I need to be certain I have $200,000 in my IRA that I'm willing to commit. Because what I cannot do is make the investment out of my IRA, let's say the first $50,000, and then the second $50,000 or any future capital call, just pay that personally. The IRS says if your IRA owns that interest, it's responsible for any income or expenses, in this case capital call, tied to that investment interest. So we just want you to be aware of that. We don't see it frequently in the angel investment world, but it does happen. Or investors may be diluted because there may be a follow-on round of investing, and they may not have an IRA to invest in, or any further IRA money to put into the investment. So they'd have to be diluted. If the individual's ever going to put personal money in after an IRA investment, it has to be treated as a separate investment. So they can't combine those two investments after the fact and call it one. If there's another future opportunity to invest and they make it personally, that is a separate investment from the investment that they've made with their retirement account. So that takes us to the last slide here with questions. We're right at just a minute or so past 1:30. I'll pause for a second and take some questions. While you may be typing those in, I'll just give you a little bit of an overview of who we are and what we do. New View Trust Company is a third-party custodian. We serve a similar role to a Schwab or Fidelity in that we hold in custody investments. Where we differ from them is, number one, we only hold self-directed accounts, so accounts where the individual makes all their investment decisions. Another big difference is we don't have investments to offer, so we're not a matchmaker. We don't sell, endorse, approve, or recommend investments to our clients. So we're just the custodian. We do it in a passive manner. We don't limit our clients to public securities. We specialize in alternatives. We custody $1.3 billion of assets, so we're a very large company in this space, and every bit of that $1.3 billion is in alternatives. So private equity, angel investing, real estate, private notes, mortgages, convertible notes. So if you're looking to fund businesses or other investment avenues, we can be a great opportunity and resource for you to be able to talk to your investors about not only the opportunity to use their retirement money and the benefits that we spoke of today, but we can be a resource that you can refer them to establish the account and get that investment made on behalf of the account. So at this point, I don't see any questions that have come in, so I will use this time. Oh gosh, I've got one that came in. I'll read this here and get us wrapped up. Thank you for the question. It says, I have multiple IRAs and 401k rollovers. Must a single account be the owner of the investment, or can several IRA accounts own part of the angel investment or follow-on rounds? So when it comes to multiple IRAs, there's a few different ways to structure the deals. So first of all, anything that's pre-tax, so a traditional IRA, a 401k rollover that's pre-tax, all of those accounts can go into one. There's really no reason in today's environment to keep those segregated. So we can combine all of that. The only thing that would need to be different would be Roth accounts. We do see some cases where people like to keep 401k rollovers separate if they're large balances for some of the asset protection. But if the balance isn't significant, IRAs carry enough protection that there's really no additional risk. But assuming that you had all your pre-tax IRAs in one account, your 401k rollovers in segregated accounts, and you wanted to participate in let's say an angel investment, you could do so in really two manners. Number one, each account could become its own investor. So you would invest into company A with, let's say, 3 different accounts. We'll call it IRA 1, 401k 1, and 401k 2. And they would all stand alone. So the investment company would treat it like 3 different accounts. We would treat it like 3 different accounts, and we would hold each investment. And then follow-on rounds would be handled individually by each account. The second way to do it is to prorate out the investment. So hold an investment hold that investment as one holding, but have the title reflect the 3 owners. That's a little more convoluted in we see that a lot more commonly in the real estate space. It's a lot easier to slice up investments in the private equity or angel investment world, but you certainly could. What you cannot do is you cannot have IRA 1 make the investment, and then if there is a capital call, have 401k 1 cover the capital call. If there were future rounds, you could have your other accounts, as long as the investment sponsor was okay with it, come in those follow-on rounds, but they'd have to be clearly delineated on the company's books as separate investors. So, Series A, IRA 1 owns Series A, IRA 2 owns Series B, 401k 1 owns Series C. As long as it was crystal clear and the amount of money they put in from each specific account was record kept separately based on the series, and we would handle that on the IRA side, and the investment sponsor or portfolio company would need to do that on their end. So great question. I appreciate you asking that, because that does come up quite a bit, and we can talk a little bit more offline if you do have questions. So again, Newbie Trust Company, we've been around for since 2003. We hold well over $1 billion of private assets. Our desire in all of this is to simply help you be better capital raisers. We can't make your offering sound better. We're not going to sell it. That's not our role. But what we can do is offer you the ability, when you're out going through the process of raising money, we can give you another tool in the toolbox, which is retirement accounts. We encourage, the individuals to be proactive, not to wait for an investor to tell you they want to use an IRA, but simply let them know that it's an option. We find that it increases either the amount of money that people put into a deal, or it allows people that may not have been able to participate in the offering. It creates opportunity for them to participate because they have money that they didn't know was eligible to invest. So we encourage everybody to let their investors know it's a possibility. You don't have to be the experts. We're happy to educate your clients on how it works in an IRA, but we won't step in and fulfill your role, which is we don't provide them the necessary information on your offering. So we both have a role to serve. We can do it in sync and create a real synergistic approach to your capital raising efforts. So regardless of whether you're at the fund side or whether you're at the portfolio company side or somewhere in between, we'd love the opportunity to talk a little bit further with you about how we can be a resource for you. You can see our contact information is there. We have an institutional solutions team that specifically handles our private equity and angel investment clients. So please give us a call and let us know how we can help. Thank you so much for joining us today. Appreciate the time and all the questions that were asked. Take care, everybody.